What's up, YouTube? It's Joe Catchpolia sitting on the couch trying to make some money investing in fractional real estate online as usual. Today I'm looking at this 32 unit property on Brownfield Drive in Lubbock, Texas. This is one of the newer properties brought to Lofty. To give you a little bit of more info, this is 32 units of I think somewhere close to 60 that this current owner that's bringing it on owns. But apparently, they own 32, and then there's somebody that owns other units in between, and then they own the remaining, maybe 28, if I understand it correctly. And so at the moment, they're just bringing the 32 units on first. Um, they call it one apartment complex, and they kind of run it, they manage it as if it were one. But it is two different parcels as far as I understand. So I don't love that it's split in two. If you have a tenant that wants to come and live in one, and at the moment they have some on the platform and some that would just benefit them 100%, there could be the temptation to just take the good tenants to their units and bring the other ones on these ones. I don't necessarily think that this particular owner is somebody who's planning to do that, but it is always whenever you have. We ran into this one other time when we were looking at that duplex that was run as two different properties on here, each side being a short-term rental. I didn't really like that either. I think. Well, I didn't mind once they both were brought to the platform. I think it's less worrisome as long as they sell out a similar amount of equity in each. But when they have, if you're operating two and you have one that you get 100% of and one that you get 50% of, you can see how there could be some temptation to play favorites with that. And just something I wanted to throw out there. I don't think that's a huge concern, but it's something that I always think about stuff like that. Uh, One of the things right away you can see that I worry about with this property is just how close it is to the highway. I haven't been to this particular one. It looks like it just looks super close. And from my experience in general, people don't like to live that close to the highway. Whether I mean, for the most part, just because of noise. It's something like this is the service road right behind them. I don't know. So I find that to be a little bit worrisome, especially when none of the comps that were used were similarly situated, or maybe just one, and it was also one of the worst comps. Um, I really want to like this one. I started my career in multifamily. My first personal investment was a duplex, but I also started working for a company that bought. My very first job in real estate was for a company that bought very large apartment complexes, and I was a financial analyst there. And so, I'm a big fan of multifamily. I think in Texas specifically, it's a great asset to hold because of rapidly growing populations. Lubbock is no it hits that criteria, right? We have very strong population growth there. Um, it is a smaller market, but it's not tiny. It's over the 100,000 mark, which I think is I think of that as a pretty hard minimum if I'm going to have a decent sized multifamily property. So there's a lot of reasons that I'd want to buy this, but that I'm just trying to share some of the negatives as well. And they're not hiding this fact, right? You can see it plain as day. Um, they actually provided just a ton of those pictures, which I thought was a little bit funny. Whenever you get a whole bunch of the same picture, one of the things, each one of these units does come with a one-car garage, which is pretty nice. It does look like parking setup. It just seems a little bit weird, right? But it is. They were built in the '90s. Um, I think probably were always somewhat affordable housing, not in the legal sense of subsidized housing or something like that, but workforce housing, right? Like stuff that not luxury apartments by any stretch. Which is fine. I think that that's actually, it's an asset class that I like. And they do actually in here talk about some of the income is coming from the housing authority, I believe, the city housing authority. And so it is, maybe it is actual affordable housing for some of the units. Um, one of the reasons I really like to invest in commercial properties, or one of the things that I think, investing on, especially on lofty and, places where we're not paying for the due diligence directly, it's really nice. They provide, the full commercial appraisal for these, which are, have a lot more detail. And I'm not going to share the whole thing because it is their work product, and I don't think we're supposed to do that if when I read the whole description, although it is in the public Dropbox, so you can take a look at the whole thing for your due diligence. But there's a ton of info there. They talk a lot about the market. They talk a lot. They go into great detail about the construction, and you get all the info from all of the comps that they use. But I just, again, I'm not going to go through all the due diligence that I looked at for this property, but I want to give you a couple of the highlights that I think make this property a problem for me. Okay, the first one is, the total value, right? They're saying, okay, we're asking you to pay 3.486 million. Let's see how that matches up with the appraisal. So first, I'm just going to go to their opinion of value. They're saying an as stabilized market value based on the cost approach, 3.34 million. So where were we at? So already they're asking us to pay $150,000 over the stabilized value in the appraisal, right? And the stabilized value means once everything is rented up to market rates, and it's fully occupied. Occupied, not, and that doesn't mean 100%. It means what they believe is a stabilized occupancy, and what they said that would be in this appraisal is 95%. The property's not currently, there's it's at 91% occupancy. Really, that just means they have to fill one more unit. But the current rents are way below what the stabilized rents that they're putting in here is. So one of the things that they did is they said, okay, well, that's that's what it is, stabilized. So if it's 95% full and they're all at $950 a month, this is this is what it would be worth. But then they say, okay, but it's going to take a while to get there. So they did this calculation and said, okay, let's subtract $20,000 from it. So it's really only worth 3.32. Well, okay, so we're being asked to pay considerably more than that. And when you look at, I was trying to take a real hard look at the rent roll, and you can see, they're saying market rent is $950 for all of them. And okay, we have a recent lease. It's a $950. That's fantastic. Another recent lease, $950. Okay, then we have these old leases. You got a $740. You have a $850. This isn't that old, but it's before the current owner took over the property. So I think that's fine. I'm going to call that not a recent lease, right? So $850. You have one again, recent one, $950. So that's looking pretty good so far. Or, older ones very low. But then you have this one that was just done at the beginning of December, and it's at $900. They knew they're bringing this property on right now, so you would think if it were at all possible, they would have gotten to that $950, to make it really show that, hey, that's the market rate. Because this is one of the most recent, or this might be the most recent lease, and they couldn't hit the $950. So to me, that's a little bit worrisome. It makes me wonder, like, how hard are they really working to get those $950s, and is it feasible to fill the whole thing with $950s? And is it feasible for the cost of that $20,000 to do it? And I'll show you what they did there. So it said, okay, all of these units, this is how much their monthly rent is different. What are they doing here? Units 30, 2750. They're basically saying like how much it is average monthly rent. What are they doing? Okay, wait a minute. I thought I understood this chart, but now when I'm looking at it and I'm talking about it, the 112 is throwing me off. What? Oh, no, okay. So this is $838 per unit per month is the current average. $950 is the amount that they're saying that's the market rent, and so that's what that is. This is the difference between the market rent and the average currently. And so what they're really showing is, what your, how many units are below it, in each of these time periods. So they're saying in the first month, you've got 30 units that are all below it. And so basically they're saying like every month you're bringing a few more units back up to that full rental rate, right? Um, just fine. And then they were like, okay, well, what does that cost you? We're discounting the difference, and that's how they came up with this 20,000. They rounded it to 20. I mean, when I say see 20,700, I round that to 21,000. But that's which is which should be a subtraction, right? So that's problematic. Um, but when we really take a look at these, right? So we're trying to fill this up more and also bring these units up to market. Well, if I'm this 740 guy, I'm not paying 950, right? Like more likely than not, you're losing this tenant. Uh, Probably some of these 850s are going to move out, right? And definitely these 700s and 760s. I mean, the chance that you get all of these people to renew and to renew at that higher rate, I think is very close to zero. That they'll all do it. I think you'll probably end up either either losing a large number of them or signing new leases with them that isn't all the way up to the 950. Like if I own this property, I have this 675 tenant. I know to get to the 950, I probably have to rehab their unit a little bit when they move out, which costs something. And I didn't see any allowance for that when they were doing this calculation. Where were we? Over here. And so I'm probably going to say, okay, if they're going to get it, if I can bring this 675 up to 850 or 900, I'm okay with that. Well, if the difference between 900 and 950 doesn't sound very big, right? $50 a month. But when you're talking about valuation, I mean, that's more than a 5% move, right? I mean, 900 to 950. Yeah. And so if you have several of those, you're going to have a really strong impact on your value. And so let's see. This value, this stabilized value is really, it's dependent upon getting to 95% occupancy and bringing every unit up to 950. And I think that to do those two things, it just seems like it's really difficult to believe that you're going to do that without breaking your occupancy in the meantime and without doing some major rehabs on those turns. Because, some of those, let's go back to that rent roll. One of the reasons that they're getting higher amounts is because there were some renovations, but I don't necessarily think that they renovated one that this person's been living in since 2017, right? Or this person has been living in since 2008. Like I think that it's very unlikely that this is a renovated unit. And it's probably why that they are paying such a lower amount, right? This happens. You see this a lot, but to be saying, well, we're only $20,000 off of this being stabilized, I think that's a pretty big stretch. And I just want to point out, this is my opinion. I'm not an appraiser. It is, this is just based on my experience in multifamily, and sometimes, this is it can be very far off, right? But sometimes it's easy to say, oh, well, the market occupancy is 95%, and it looks like these should rent for 950, and we've got some that have rented for 950, and they do a rental comp analysis. I'm not going to spend a lot of time, or I'm not going to spend any time during this video digging into that because I don't want to be here, for too long with this. But I think that some of the ones that they picked didn't make a ton of sense as far as quality, and especially with which ones they gave the most weight to when you looked at like which ones were the closest to the property. But so regardless of that, I think ignoring all of that, the thing that I find the hardest to believe is that we're going to get it from the current state to the fully stabilized state and only spend $20,000. Um, so I think that that's a stretch already. And then and this is the cap rate they're using to get to the price point. They're using it a 7 cap, right? Um, but then there's some things that are happening with the way the current owner, that seven cap and all of this income, it's not based on the current income. We're not given, there's no trailing 12. There is, we have like 4 or 5 months of, uh, let's see, where is that one? We have 4 or 5 months of performance. I don't even have it here. Yeah, here we go. Uh, Rent roll, profit and loss statement, right? We don't, maybe a little bit longer. 1, 2, 3, maybe 7 months. But, so we have normally, if I were looking at multifamily properties, especially large ones to purchase, I'm always getting at a bare minimum the last 2 full calendar years of financial statements and a trailing 12. And when now this is kind of a smaller multifamily, like if it's 60 units or if it's this is just 32 units of what they're calling 60 units altogether. Um, in that scenario, sometimes you're working with these mom and pop owners, and you're not going to get good data. But this is really just a very, very short time period that we're given. And so that's not what the appraiser's applying the seven cap to. They're just going through and coming up with, okay, this is what we think the rents should be. This is what we think the expenses should be. Um, these are what market rates are for all these different things. If those were accurate, if their income number is accurate, then this should be the value based on a seven cap. So they're basically saying we think this, the market for these multifamily properties, we should be capitalizing income at a seven cap. Well, when we go to the financials tab on Lofty, and they really, in many ways, don't take out, we've talked about this a number of times. They're not taking out all the things that I would want to take out. Uh, and they're calculating a 5.65 cap rate with their price and just taking out the things, just taking out taxes, insurance, property management, utilities, and getting to this annual cash flow number that's significantly lower than what the appraiser had figured. He's saying 232. They're all the way down at 198,000. The reason that this is so far off, um, or one of the main reasons, is this property management number. If we look at, let's see, the management agreement, they're charging a 25% management fee. And they're saying, well, that management fee will drop down to 10% once the loan is paid off. And the reason they're doing this, if you remember, is because of the way that, Lofty handles the loans. And it doesn't, I always say it's the way Lofty handles it. It's the default. It's the way that it's usually done on Lofty. It's not required to be this way. There are, or at least there's at least one property that's doing things a little bit differently. But basically, the loan sits outside of the income structure of the entity. And so um, you have the co-owner that brought the property to the site. They're selling their equity. People are getting paid out based on the income of the property. But when you look at the income, one of the expenses that you don't include is the principal and interest, and that's paid for by this co-owner that brought the property to the site. Well, in order for him to be able to afford to make that payment, he's saying, well, I need to just charge a higher management fee. And I mean, he's very upfront about it, right? It is in the description. Um, let's see. Property leverage, right? It's saying, oh no, there's another spot. It's under the property management fee, right? He's saying like I need to be able to do this so that I can pay for the debt and so I can bring other properties to the platform. And that's fine. Like I understand that's the reality of it and the way that it's set up, but it makes it so that I did a video a couple of days ago. Sorry about that. My screen recorder froze. It doesn't like when I'm jumping around tabs. I actually recorded another video that's going to pop up right after this, I think, but or not another video, but I'm going to keep talking about the analysis. But I just wanted to throw out there real quick because I always forget to. Uh, Please like and subscribe if you haven't already. Please throw in any questions about aspects of this property or others that I've talked about. If you have ones that you're interested in hearing more of my thoughts on. And then also in the description below, I have links to all the sites that I'm currently investing on. Uh, that's it for now. I think I'm gonna freeze again, and then you'll hear one more apology. So sorry about that. Sorry about that. My screen recorder froze again. It seems to have the biggest problem with me jumping from one tab to the next. I'm going to try to keep that to a minimum from now on, but I know I'm talking about a lot of different things. But so, he's very upfront about needing the larger management fee in order to pay for the debt. And so, but that whole structure is what creates these unrealistically large yields in the early years. And I think in this situation, there's a real risk of not being able to pay the debt, or so this is part of the loan assumption agreement where it was taken over. The outstanding debt's 2.5 million. Um, it's showing these are the interest only payments, the amount of the debt that's being paid each month, going up to $20,000 a month during this interest only period. So we're not even making amortizing payments, and we're at $20,000 a month. And I want to show you again our current net operating income at the moment. Uh, our total rents aren't hitting that number, and so um, this didn't make a ton of sense to me. Uh, how we could be, and they are expecting to increase those rents. And one of the things they said is they weren't getting, like 32 units times 950 should be significantly higher than that, right? 32 times 950, you should be getting $30,000 in rent. We're way off of that. They said something about the housing authority not paying. We know that the lease rates are lower. So there's, the performance that they've had so far is just not getting it there. Um, and they were able to pay lower amounts, but now starting from this month and going forward through the end of 2026, it's $20,000 a month. So if they're not able to get those rents up and the occupancy up, that's a tough payment to make, and that's without any amortization. And then at the end of 2026, this loan reprices. It becomes an amortizing loan, and they're using the Wall Street prime rate plus 5%. And so, I want to say that's like 12% today or something. I could be wrong um, about what that actually is percentage wise, but this is a loan structure that is just terrifying to me. Like, I would never, one of the reasons that you invest in multifamily is the ability to get fixed rate agency debt, right? Which is like 30-year fixed rate loan. Um, I think they probably aren't able to get it on this property currently because they don't have the operating history that, I think maybe they'd end up with far less proceeds. Um, you know, so it looks sort of like, bridge debt. It's the type of loan that's going to get you to a point that you do get the property stabilized. And I actually didn't notice if there were prepayment penalties or not. So hopefully they have the ability to pay this off. I didn't even notice. Uh, but it's a tough loan to be making the payments on, especially with the current performance. But once you get it better, better performance, it seems like you should be covering it fairly well, depending on what your expense ratio looks like. But so but even with that structure that normally juices your returns a little bit, um, because of how low collections are currently, uh, the the cash flow was not anywhere close to what it needed to be, to create this 20% rental yield, which seems like it's kind of become the standard for new properties that come onto Lofty, and people are doing, whatever they can to try to get these high teens or 20% yields. And I think that some of them are proposing structures that I think they're going to have a hard time maintaining. So this one, this is what I want to get back to is um, the current owners providing a rent credit of $17,000. This is per month to, so basically adding this to what they're collecting, right? So, and I know I said I'm not going to jump back and forth too much, but I just, so like 17,000, whatever, plus this amount. Okay, that's how we got to 30,000, and then you subtract the debt and everything. So that's how they're getting to this 20% rental yield. And then they just put in one line that said a rent credit will continue to be provided to maintain the 20% rental yield based on the $50 token. And I posted some questions to one of the Lofty employees in the Discord, and I was like, well, what does that mean forever? Right? Like if this property, if it never gets ramped up, is he obligated to continue paying that forever? And if so, like that doesn't seem economically feasible to me. I mean, even so, there's 2.5 million in debt, and we're selling out basically at about 3.5 million. So okay, I guess really he could sell $900,000 in tokens, right? And still keep his 10% roughly. I mean, it's a little bit less than that. And so then, okay, if providing that credit's allowing me to sell those tokens and make that money, then that's great. But then, what is over time? And I don't think that that's what he's doing. I don't think he's going to sell the full amount, but it just seems really like this is again the same problem kind of with financial engineering that I was talking about the other day, is that this rent credit is just, we're not really buying this property for its current performance, right? We're buying, if you buy this token today, you're buying it based on the promise of the guy who's bringing it to the platform that either he's going to bring the performance up to the level that he says, or he's going to keep making that payment. And I don't think that anybody who's bringing properties to this platform is expecting to have to make that payment forever, right? And so buying properties like this, where they're providing these rent credits, is just making a bet that they're right. Because if they're wrong, especially if there's somebody who's buying multiple properties, bringing multiple properties to the platform, and having to do this sort of exercise where they're giving a rent credit and or taking a larger management fee to help them cover things. And I mean that's actually sort of a silly scenario, right? Because the bigger management fee is in large part why the rent credit's necessary. It's not completely, because even with a normal management fee, you're going to have a problem uh, when you only have $12,000 in collections on a $3.5 million property. But the other thing that I forgot to point out when we were looking at the management, it's 25% of gross rental, but then after the loan is paid off, they're still looking for a 10% management fee. And when you hire someone to manage a single family home for you, 10% is pretty normal. Like I see that all the time. But when somebody's managing 32 units for you, 10% is a really high management fee. And so that's one of the things that I've noticed a lot from a lot of the Lofty co-owners, as they are just continuing to have these very high management fees. Um, I don't really know. I don't know if it's because they think there's just unsophisticated buyers and they don't really know what it should be, or if it's because there's just a limited supply of properties on here, and so there's not really that competition to have like. Uh, what's interesting is all the competition seems to be about providing this best yield, because that's what a lot of the buyers are buying. But for me, this is just a really tough buy if you think about what we were talking about yesterday about value investing. And we're buying into something and paying, you know what did I say, 100 and, even if you ignore closing costs, right, you're like 150, $166,000 over what the yeah, over the stabilized, the stabilized yield. And like I said, I mean, I don't think this is a stabilized property. And so he's trying to take away some of that risk of stabilization from us by providing that rental credit. Um, the problem is when if I don't know anything about this person's personal financial situation. If they were a billionaire and they could fund that rent credit forever, and it was in some way contractual, which I don't, it looks like it's a couple of sentences on this page, and I couldn't find, um, maybe it is in some other agreement that I just missed it. Because there's a whole bunch of, diligence documents on here. But basically you're buying this, um, just in the just trusting that the co-owner is just going to be able to continue to make those payments, or that at some point in the future the property is going to be brought up to that stabilized level. Um, and then that yield, though, it is still very dependent on that debt structure where the co-owner's paying that debt out of their side of it. I don't know. So again, I really like the market. I'm a big fan of multifamily, especially sort of what I think of as more like workforce housing. But for me, at this price point, I can't jump into this. One of the things that I think makes this especially good for this platform, before I even saw the rent credit thing, is that having a larger multifamily, you should have very smooth income from it, right? And I think that that's going to do very well on this platform. So I think in general, if the performance of this gets up to where they're expecting it to be, um, I think that this is one that'll do very well, for the long run, because you won't have these like big dips, like the single family homes. Every time you have a dip in, you have a month of vacancy, prices crash because people see, oh, I've got no yield this month, and there's a lot of really short-sighted investors on the platform. So something like this, where you should have very smooth income, unless you just have multiple units that are really trashed in one month, or some major problem. Um, I think that in general, multifamily should do well on the platform, but I just don't know. It doesn't mean I want to pay over market value for it, right? Like one of the things, especially because I talk a lot about there being platform risk in general. I haven't brought that up in a while, but Lofty is still only a few years old. Um, you just never know what's going to happen with the platform itself. I hope that it does really well, and in the long run, there's we end up with thousands of properties on here, and this will be an amazing place to just invest in. But realistically, something could happen and the site could go away. And so my downside protection is, what can we liquidate this asset for? Hmm. And if the answer to that is, well, it's a number, you paid more than the liquidation amount for it. Well, I'm just not very excited about doing that. And obviously there's trade-offs, right? Like, well, I do like the idea of getting a 20% yield forever. But for me, that also is just not guaranteed. It's guaranteed, maybe, like the person saying they're going to do it, and that, so in some sense they're providing a guarantee that they're going to keep it at that. But it is not, that's completely dependent on their ability to continue to do that. And that's not something that we've really been given any due diligence on to be able to know that that's possible. So I think that's really all I want to say about this one. I am super curious about other people's feelings about it. I'd love to see, uh, somebody bring a truly stabilized 7 cap multifamily property to the site, um, and see how it does. And, or the other thing is, 6 or 8 months from now, this might be a deal that I'm really excited to jump into. If if the tokens haven't gone to $70 or something, and then again, then I'll continue to chase that valuation. So, at least for me, still, I think that the better opportunities are a lot of the discounted tokens, and where you're getting a true discount to the real world asset price. And maybe you are here. One of the things too is that appraisal, it is just one person's opinion of value. I do tend to think when they the cap rate, it looked like that a reasonable cap rate to me to apply to this, and so then using it on the numbers that are presented here, it actually should be worth even less. Um, I think that's problematic, but now I think I'm just starting to repeat myself a little bit. I think that that's all I've got to say about that. I always forget to ask until the end. Please like and subscribe if you haven't already, and let me know like if there's certain topics you'd like to hear me cover. If there's any other platforms, I'm not married to Lofty or Mogul or Ground Floor. Those are just the ones that I found that I've been putting money in already. I think Lofty presents some of the most interesting ones, and that's why end up talking to them about them quite a bit. But I'm really open to exploring some more. I think I've mentioned it several times. I took my money off of land. I don't think that I would do that one. Arrive, I'm just not really excited about the returns because of the way their fee structures are. We talked about Arc 7, which I should probably revisit that one because I felt like it was close, but there just weren't the opportunities that I was too excited about yet. But also part of that was because I think they had their fee structure kind of nerfed the returns a little bit. Um, in any case, I think that's all that we've got for today. So until next time, I'm going to keep making mistakes so you don't have to.